Hey, what's up, everybody? It's Stephen A. Williams, president and founder of the creditrepairshop.com. And I'm doing a follow-up video on a video that I did probably earlier in the year, and it was about the FICO 10 model and how it was going to be able to change the way that lenders were going to be able to look at your credit history. It was one of the first things that changes that I saw, and I felt that this could screw up individuals' credit scores, that it could actually lower credit scores, was because it was able to do a 24-month lookup. And so in this here, this is straight from their website, and I want you to take a look at this because a lot of people have reported that they've done everything right, paid their bills on time, even paid off their credit cards, when by the statement dates, and that their scores went down. And I said that, I bet you're being affected by the new FICO 10T. FICO 10T, which stands for trending scores. Like, this is something that is going to be affecting a lot of people. There are reports out that there could potentially be over 20 million people who will have their scores lowered 15 to 20 to 30 points just because of this update. And even if your scores do not go down, when these lenders that are going to be using this, which all lenders are going to move to it because they want to get more trending data to see if the risks that they're making are good, and that's the way that they take their risk, is by getting all the data that's available to them. That you could go in to get a loan, and depending on the filters of the mortgage company, the filters of the credit card company that you're trying to get a credit card from, filters of a personal loan, credit union, that those filters could actually make your FICO score go down, even though your FICO score shows a different number when you're looking at it without running your credit. Let me tell you the reason why. This is something that we're all familiar with. They've asked questions like, are you married? Are you single? College graduate, high school graduate? Have you lived at your residence for 2 years or 1 year? How long have you been on your job? These are all risk. These are like filtered into the approval process of lenders as risk data. So they know that if you're married, you're probably going to be more willing to pay your loans because you don't want to disrupt the family. If you're single, maybe it doesn't really mean that you're not responsible, but the way the data is filtered is that they feel that you could be more of a risk because you only have to think about yourself. And then staying in a residence, if you've been in a residence for a while, that shows stability. If you've been moving from place to place, it shows instability. If you own your home, that shows stability. If you rent, that shows that, it's going to be more on how long you've been renting. And then the other factors, like if you're a college graduate, they believe that college graduates over a period of time are going to earn more money than people who do not go to college, which we know that is not totally entirely true, but this is the way that their risk departments risk and rate and put in and approve and deny or offer certain rates to people. This is just the way that it's done. Now, with this new FICO 10T, which is trending, and let me just read this part here. This is what's the most important part about FICO T, because I know a lot of people are going to be upset. Some people, I don't want to say a lot, but some people are going to be upset because they're going to go for a loan and they're not going to get approved, or they're not going to get the rate that they expected to get based off of doing everything right on their credit. So it says here, trending data gives lenders a different view of the borrowers. FICO 10T will use trending data to show lenders something different about borrowers from their traditional information. Trending data gives prospective lenders borrowers' key, balance, and payment data for the last 24 months. Now, before I move forward, I had made a video in the past talking about if you have a late payment, it's going to take you 24 months to overcome that. On the credit reports that were previous, it just showed a year on there. And I had stated that even though it does not show 2 years on some of the reports, that they were going to start with this FICO 10, and some creditors were starting to use it, and that they were going to actually look at what you had done for 24 months. Now, all of the monitoring services and the credit reporting services that offer credit reports are now showing 24 months data. That's across the board. But what was not changed until recently, or when a creditor started using FICO 10, is that even though it showed it on there, that would be something that would be looked at under manual underwriting. But now the algorithm for when they're pulling the data is going to be figured off of 24 months. So if you make any mistakes with late payments or anything over a 24-month period, that's going to affect your credit scores, and your scores could actually go down when you thought that you overcame that late payment. Now, because the way that it's going to be figured with FICO 10T, it can actually drop your scores. Now, it says here for payment data, so I'll pick back up here, key balances, balance and payment data for the last 24 months, which enables them to see consumers' behavior trends and determines if they're carrying balances, consolidating, or paying off their balances each month. Now, I can tell you how this will work with the FICO 10T. If you're carrying balances, it's just going to be, basically, they're going to have more months to see how you're carrying your balances and what amount of balances you're carrying. A lot of people were able to escape consolidation, and that's why a lot of cards started seeing, hey, you're getting another card and moving the balances over to that card and taking it away from my card. They just about put an end to people doing that. They would just cancel out the card if they catch you doing that. But now people were saying, okay, well, what I'll do is I'll consolidate. I'll run up my debt, or just, I'm making my payments, so I'll be able to qualify for one of these companies that are offering these consolidations. And so it could make you look good on paper. You got one payment going to one loan. But what they're doing is they're starting to look at, hey, this consolidation that they got was from this group of either credit cards or personal loans, whatever it was from. They're going to be able to have access to that data, and that's going to be figured into how they're going to rate the FICO scores. And it says here, or paying off balances each month. This will work in the other direction. When they see that you're paying off balances each month with the FICO 10, they're going to consider that you're an excellent risk and that you're going to start getting a whole bunch more credit card pre-approval letters in the mail. I get them all the time, and it has ramped up. I'm talking about every company, my bank, other banks, even the cards that I currently have, saying you can move up to this card and keep that card, because they know. So they're going to have even more data to say, man, this person for 24 months, not only what we see, but we can see that they are not falling into that risk factor, figuring it in for 24 months. And remember, this stuff is done by a machine. This stuff is done by AI. It's not done by people anymore. So if they say this is what we're looking for, it's going to automatically either trigger out denials, it's going to trigger out interest rate approvals, and it's also going to trigger out to send more applications to certain individuals who are actually paying off their balances, and they're trending towards being an excellent risk. So it says here, many lenders may want to leverage the most comprehensive data possible to make precise lending decisions. It says here, Jen Willman, Executive Vice President for Scores at FICO. So this is straight from the horse's mouth. By offering a score that taps further into trending data, because they want to see where you've been, what it looks like you're going to, because that's going to allow them to make better decisions. It says that lenders gives lenders greater flexibility and power, as well as an ease of integration with their system. So I predict that all lenders will be on the FICO 10. They're even making it easier for them to change over to the new FICO 10. So wanted to get that information out to you. Please like this video. Please share. Post your questions and comments. If you need help with your credit, please visit us at creditrepairshop.com. Watch video What Makes Us Different so you can see my 8-point validation process, my 2-phase settlement process. If you need your credit reports and scores, go to the website yournumber3scores.com to grab your TransUnion, Equifax, Experian, credit reports, and all 3 scores. If you have debt collectors coming after you, grab my 3-pack of letters. You want to do this early in the game. Statute of limitations letter, debt validation letter, and cease and desist collection activities letter. I give you the instructions on there. You can see the link below this video. And thank you for your time. Please subscribe to the channel if you haven't done that yet. This is Stephen A. Williams, President and Founder of the creditrepairshop.com.